You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Welcome to the show, Danielle.
Thank you, Jim.
Scary when it comes to consumer debt, but apparently people are spending less and paying down debt and even saving. Is that possible?
Well, not in Canada yet, Jim, but I'm encouraged by the trends in the United States because the consumer spending there is really what drives consumer spending in North America, and consumer spending in North America is really what drives spending in the whole world. There's a general rule of thumb is that households in North America spend 10 to 1 what developing nations do in places like India and China. So when we pull in our spending, it makes a big deal for consumption globally and the whole sales revenue numbers for corporations globally. And so that was an interesting trend. We got the April data. U.S. consumer spending was flat in April, and the consensus had been expecting an increase, and that marked the only actually slightly positive increase there was in the last 5 months was in March, and so it's quite a profound trend now. Year over year, you've seen overall sales, consumer spending up just 0.9%, and that's the lowest level year over year since the Great Recession. October of 2009 saw a year-over-year number that low. So the interesting dynamics there was when you looked at why they were not spending, it was that they had paid down some debt and they had built up their savings. So their savings rate, which historically was around 10%, had fallen again to just 4.4% in November, and since then it had increased to more than 5% again in March. So some trend in the right direction there if people realize that their own personal balance sheet is their greatest vulnerability and that they have all the stress and strain and foregone spending power with all the debt they're carrying. And also, the Consumer Comfort Index and the Bloomberg Consumer Comfort Index in the United States came in weak again today. I think people are fully aware that the economy is slowing down and that job losses are beginning to peak again or to take off again. Did you see the story, for example, in Canada, Bombardier announced today laying off, I think it was 1,500 people. So you get a steady march of layoffs and companies downsizing, closing. The retail sector, is closing down a whole bunch of franchises, as you know, in Canada, and a lot of retail space is coming up empty. It's sort of this kind of wave you're seeing everywhere you go, and it just means that, as I say, the consumer is pulling in. That means less consumption globally. That means more inventories, and you've got huge sales. So the inventory to sales ratio currently in the retail sector is at one of the highest levels it's ever been. In other words, that bodes poorly for manufacturing and or new orders going forward when people or companies already have massive inventory and a poor sales ratio going out. So it just means that, again, I think that the whole slowdown in the economy theme is starting to become more evident. And, the GDP Now indicator, which we've talked about before, it's a more real-time measure of U.S. growth and U.S. gross domestic product, again, 70% of which is consumer spending. That indicator has gone down again of late as well, and although it was negative in the first quarter and people had expected a big rebound, there was a talk of a big rebound in the second quarter, with all this recent data coming in weaker, the GDP Now is looking like it might be 0.7% in the second quarter. So that's a huge drop below the consensus, the sell-side consensus, which is always expecting robust growth and a pickup any day. They're looking at something like in the 3 to 4% range for GDP expectations. And in reality, the first half of the year is probably flat at best.
Why do these central banks every year say we expect 2 to 4% growth in spending and in the wealth of the nation, and yet we see things that are 0.1% or 0.7%?
Because I guess they're just totally deluded by their own theories. I go back and forth. I think they're sociopathic sometimes. I think they're foolish. I think they lack wisdom. I think they're on the take from the industries they represent. And when people like Ben Bernanke leave public office and go work for major HFT firms and, pick up huge speaking gigs for major financial institutions, it makes one very suspicious of the policies he was wielding while at the head of the Fed. I'm not a conspiracist normally, but I have to say that it really is a dark area. The amount of nepotism and conflicts of interest which are so rampant, and then you see him go out and get these big gigs. You wonder, but the irony of someone like Bernanke is really quite incredible because, he was this Princeton professor who, styled himself as an expert on the Great Depression and wrote papers chastising the Bank of Japan, in the late 90s, saying you guys are screwing up because they had the big asset bubble that burst in 1989, the stock market and the housing property market had burst before that, much like the U.S. did in the 1925 property bubble that burst, and then, the Fed stepped in and ramped up, a bunch of stimulative policies, slashed rates, did all this bond buying, a sort of an earlier version of the QE they reinvigorated in the past few years. They were doing back in the 20s. And ironically, it blew up in a spectacular fashion, of course, because, as we know now, the stock market crashed in 1929 and was the beginning of the Great Depression that went on for years. And you've got these transcripts of officials and people speaking about the run-up into 1929, what were the causes and what brought about the crash. And in 1931, you have them saying things like, well, it was the efforts of the Federal Reserve to ramp up credit to force consumption that blew bubbles, and then that all collapsed. And, they knew then that in the 30s that it had been an erroneous policy. And so Japan, ironically, when their bubble burst in 1989 and it all went south, they didn't jump to do QE. And one of the reasons they didn't was that their American-trained economists said, hey, you know what, there's no point in trying to do that kind of asset purchase manipulation, to get rates even lower, because we already tried that in the late 20s and 30s, and we know that it didn't work. And so they didn't do it for a number of years. And there you have the young Ben Bernanke as the professor chastising them and writing papers saying, that they're missing the boat and they should be doing this. So finally they capitulate in about 2001 and start this great operation of buying back their own government bonds. And here we are, all these years later, 14 years later, the Japanese economy has continued to languish. The debt levels are the highest in the world. The balance sheets are unsustainable. The stock market, although it's rallied significantly many times in the past 14 years, is still 50% below where it peaked in 1989, Jim. So there is no evidence that these policies work. There never was, not from the 20s and not from Japan's experience, and yet that's where, Ben Bernanke led the Fed in 2010 to roll out these policies, and then, Draghi and ECB and other countries, China's been mimicking some of the stuff. So you've got this whole bandwagon going now of these American-trained economists and theorists who are ramping out the same things that have already failed in history repeatedly, and they really haven't got anything else to offer, but they're doing it anyway, because it is benefiting some in the banking sector, whether they be fleeting profits or not. Some of them are, riding the wave and making good compensation from the appreciation in the asset bubble that's happened. But the downside for the economy is huge. Back to that McKinsey report that came out early this year, they estimate something like $200 trillion of global debt today, 56 trillion higher than it was. All major economies, higher debt levels than at the peak of the so-called, credit bubble in 2007-8. So it's quite a mess. They've just, and I keep thinking, I guess it has to take another massive clearing event. It has to be another, until the asset bubbles burst again and everyone's left with sort of their pants around their ankles, that's when they're going to admit that, oh, gee, I guess it didn't work. We tried, guys, but it didn't work. But, my point would be, how many times do we have to learn this painful lesson?
Everybody says, why don't they just leave the markets alone and let them adjust themselves and don't spend private, or I should say, taxpayer money to support it?
Because there isn't really any advantage to the public in funneling taxpayer obligations into asset bubbles. It has the appearance of perhaps prosperity for a short period of time. But again, as I say, we've learned this so many times that that's fleeting prosperity. It bursts and people are further behind than they were before. The coffers are that much emptier. People are that much older. They have that less time to recoup, to recover. Here's another example, that I was writing about today, the Canadian stock market. We remember back, Jim, when we were the toast of the town. We were the model of civility and progress to the world in 2008, because we were a commodities provider and we were in the midst of a commodities bubble. And so all of our revenue looked great. No one was really paying particular attention to the downside or the balance sheet or who was accumulating too much debt or who was misallocating capital. It was all looking good because revenues were very high. But then you have the implosion of all that, and here we are 7 full years since the TSX peaked in June 2008. That, next month will be 7 full years later, and the TSX is still not back, is still below where it was 7 years ago. And that is what asset bubbles do. They look spectacular, then they crash, and it takes years to try and just recover. And then you realize, now we've run out of runway here on this particular market cycle. It's already the 3rd longest ever in history, and we've had these astronomical, supposed gains, but really just getting back to where people were before. And now we're running out of runway and having to realize that the next downturn is upon us. And that means people are going to be set back further again and realize, it's not just 7 years of waiting. Now it's another potentially 5 or 6 years to try and get back my money. So it's just not a good strategy.
We'll have more with Danielle Park right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on The Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Danielle Park, editor of the popular blog Juggling Dynamite. Fossil fuel is receiving 4 times the taxpayer subsidy of renewable resources. Why are they still supporting the oil industry to that extent?
Well, I have no doubt that many would argue that it's in the public's best interest to have cheap oil. I would simply submit that has not been the experience, because cheap oil, it went to $147 a barrel there in the peak of 2008. So the only people that were really prospering and making off like bandits in that were the executives that were being paid based on the size of their revenue flow, or the share price that was able to get to ridiculous levels. So the problem is, you hear lots of criticism, and I hear this all the time because I put on things about alternative energies and new innovations and technologies that I think are life-supporting on the planet, and people will say, they get subsidies from the government. My point would be, well, first of all, you can argue that no government should never subsidize any technology or any sector, and I think that that's not right, because I think we have a vested interest, a society has a vested interest in building certain infrastructures. But when you've got a highly developed, highly profitable, the largest sector in the world, oil as an example, that is still receiving these massive, not just subsidies, but massive sway and control and influence on policies and procedures and all sorts of unfair advantage because of its monopolistic structure, because of its size and maturity. And so they're literally taking, bread out of the mouth of many other policies, initiatives, and government programs that could otherwise direct funds to them, to feed people that are an industry that is already fully established. So I would suggest that it's foolish, and when you add in the other costs of everything that we pay because of the reliance on fossil fuels, and I listed some of them there, but basically, the whole, not just whether you believe in global warming, I don't really, whatever I think the evidence is obvious, but if you want to argue that, it's not really important. What I think is we're wasting so much energy in military operations overseas and wars and environmental impacts from spills, and, this whole thing this week about Obama going to drill permitting the drilling in the Arctic stuff. We don't need to be drilling in the Arctic. We just need to develop the really intelligent, clean, and sustainable energy systems that are already here and fighting for oxygen, so to speak. So we've got this massive supply right now of oil and gas in the world. We've got record inventories in February, Jim, from all over the world. And then, as you know, prices have rebounded in the past couple of months as the U.S. dollar weakened. You saw this quick rebound, in futures for oil and gas, which is led by levered traders, same old crew, trying to make a quick buck here and there. They ramp up the price, and of course, people who aren't aware that that's a driving force are looking at it and suddenly going, oh, thank goodness, it's going back up, we can sell more. So they release even more product onto the market. So if you look at inventory levels right now, we've got the highest we've ever had. The Bakken wells are the highest they ever have been in April. The Saudis are pumping it out with well demand just everywhere you look. So none of the short-term pop is in fact given incentive to produce even more of that stuff, which we already had too much of. And to think that governments are subsidizing this operation when we already have huge deficits everywhere and so few tax dollars to, allocate to things that really matter. It makes no sense at all. But there's enormous hypocrisy. There's enormous bought politicians. I mean, the statistic I put the link to Obama's speech in 2009 when he said, called on the G20 to eliminate fossil fuel subsidies. Well, what's happened in the 8 years or 7 years since he's been in office? Federal subsidies to oil companies in the U.S. have increased by nearly half, 45% higher than when he made the speech as a candidate. So, and when the Guardian did an excellent study on, who is authorizing the subsidies, and they found out that, in fact, not surprisingly, they were all granted by politicians who've received massive campaign contributions from, the Shells and Exxon Mobils and Marathon Petroleums of the world. So there you go. That whole nepotism thing again. Too much corporate funds going into the political process. Crony capitalism funneling into corporations that are already insanely profitable. And the thing is this: that capital's finite, time's finite. Biosphere's finite. All these things. So when they're making decisions to allocate or direct funds into those sectors, they are literally doing it at the expense of everything else. And meanwhile, back on the range, it's not in the consumer's best interest to have to waste money on fossil fuels when they could be deriving, for example, some free energy off of whether it be solar or wind or various technologies that they could be using that would give them, quote, free energy relative to all these other traditional sources. And, to make your cash flow last, clearly, it's really just shooting us in the foot, because all these companies are desperate for sales. They're saying demographics aren't favorable. How are we going to, scale down overcapacity? How are we going to get back to a solid business model where the consumer can afford to spend on the things we have? And there's, one of the big pieces of that is getting the energy policy fixed so that it's much more efficient. And yet they fight that tooth and nail.
Well, the consumer definitely isn't benefiting from the lower oil price. I mean, in the Vancouver area, you're paying $1.31 a liter. It was $1 a liter not too long ago. The price of oil has not gone up that much to support that big of a hike in the consumer price.
Well, you've had wild swings. Actually, the price of oil was, if we're talking about West Texas Intermediate, was like $41 or $2, up to 60 again of late, 61. That's a huge ramp in 2 months. So it's in no one's best interest, though, as I say, because it doesn't mean that there's strong demand again in the world. It just means that price traded higher quickly on these same old culprits, the HFTers and the futures traders of the world, scalping off a few profits, but at the end of the day, it gave the wrong signal to the producers to keep pumping out more, and ultimately they're just going to drown in the stuff. So although they can keep prices perhaps higher for a little while, as soon as you see any significant breakout again in the U.S. dollar, which is actually, I think, driving the whole thing here. It's not really to do with the economic macro picture. It's to do with, what's happening with the U.S. dollar. So as soon as that, there was record bullish bets on the U.S. dollar coming into the new year, and after people had been very bearish on the dollar for years as it rallied, then everybody jumps on the one side of the boat and you get a sort of a sell-off period. Well, we've had that for the past couple of months. But as we look around the world at the slowing growth picture everywhere, at the fact that there's a lot of geopolitical problems and concerns, liquidity shortages in Europe, then you have every reason to think that the dollar will still be a favorable place for capital looking for some stability in this environment. And as soon as that trend reverses back into the dollar, you're likely to see a big sell-off in oil again. As I say, at some point, the stuff has to be cleared because the storage is just full and there's nowhere else to put it. It's not easy to just kind of, park oil when there's nothing else to contain it in. And so you get flooding of desperate countries and companies looking for cash flow onto the marketplace. Anyway, in the long run, you know what? The stats are not so far that consumers are spending more because of lower oil prices, but they're certainly able to pay other bills easier with lower costs, and they're able to pay off debt. And in the long run, that's actually one of the only things that matters in terms of a so-called recovery, is to get the debt levels going the other way. As I said, for the last 7 years, they have not gone down, they have gone relentlessly higher. And McKinsey points directly to QE and these lax monetary policies as the reason why the world has not done any productive restructuring, but has only got worse indebted. So, we'll see if the slowing economy in the U.S. makes the Feds have to go on hold and not raise rates as they had hoped they'd do. I would suggest that's probably what's going to happen. But whether or not they're going to have the actual, gall to try another round of QE with all this horrendous evidence about the damage it's doing, we'll see. I don't know. It's an election year, so there's hope that at least the rhetoric will be against something like QE. But as I say, that the powers that be that are directing the policy and the politicians are all sort of from the sectors that are benefiting the most from asset bubbles, and so it's very hard to get that that connection severed and get some reasonable policies in play again.
Danielle, thank you very much for chatting with us.
Hey, thank you, Jim. Have a good one.
You too. My guest has been Danielle Park, president of Venable Park Investment Council Incorporated. Her website is jugglingdynamite.com. You're listening to a copyrighted interview on HowStreet.com radio. Find us on Twitter at Talk Digital Net. Check out our popular YouTube channel, Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.